Morning and welcome to Money Matters Live. My name is Nev. We're broadcasting live only on onedealaway.com/live every morning at 7 a.m. And today is July 20th. It is Monday. So happy Monday. Happy week to you. I hope you are just as excited as I am to get up and get doing things. So here we go. Here is all kinds of cool and important news that we're going to cover today. And, we're going to be talking about the general market, sort of a macro version of what's happening around the world when it comes to our money. Mostly for one reason, because money does matter. And today I'm going to share with you exactly why you have to watch this show every single day so that you don't land like some of the folks that you're going to be hearing about in the show, where they don't know what they're doing with their money and are standing to get completely wiped out, financially wiped out because they were doing things without understanding of what they were doing. And this is my number one gripe around the world, that people are going out and they're blaming everybody out there. But you know what? When you don't know what you're doing and you refuse to study and you refuse to learn first, but you jump head first because you're following the herd and then you fall off the cliff, the only person that you can and should be blaming is yourself. Because all of us have a power to tune in to a free channel like Money Matters, watch live, learn a lot, and then be able to protect our money. And our goal here with One Deal Away, with Money Matters, is really to be able to provide education absolutely for free so that when you go out there looking for a way to not just preserve your wealth, but potentially grow it, this is the place where you want to be, and this is the channel you want to watch. I do want to mention that Money Matters is a free channel. We do broadcast live every single morning at 7 a.m. New York time, as I like to call it, only on onedealaway.com. And it is on onedealaway.com because One Deal Away sponsors the content, providing it for free. And if you're watching this live, good morning and welcome to the chat. Feel free to roll in, say hello, put your questions, and as always, we're going to be answering questions at the end of the show. And if you're watching this on YouTube, then do me a favor, hit the subscribe button and the bell button. You get notified every time we go live, which is just about every day, with the rare occasion of, skipping or skippage, as I like to call it. And of course, give me a thumbs up if you like the show, but don't do it quite yet. If you did it, thank you very much. But if you didn't, you might want to watch, because I think by the end of the show, you'll want to click that like button twice. So let's do this. And good morning and welcome. So, hopefully, you have had a fabulous weekend. I know mine was absolutely out of this world fantastic. I did go away. I did manage to injure myself physically, but I will live. That's the good news. I will live. So, warning to everybody out there, when you go out into the wilderness, do pay extra attention going out and playing in the wild. So that's my lesson that I want to share with you. So let's get started. One of the first thing that I want to go back in and talk about, we've talked about it here on the channel, of this week is very, very important for a couple of different reasons. The Congress is back from vacation for about 2 weeks, and then they go away again. That's right. Wouldn't it be nice to have a job where you have more vacation than working days? Unfortunately, that's not how it works for vast majority of individuals. And the reason that it's important this week is because, as you know, the unemployment $600 weekly pay is set to expire this weekend. This coming weekend is when it's going to expire. So this week, they're starting to meet as early as today to talk about potential next level stimulus. So this is going to be QE5, maybe? I don't know. But it's not called QE. It's just called stimulus or whatever, something else that they call it. So anyways, we'll see kind of how that rolls out. So they have basically about a week to get it rolled out. But in the meantime, let's take a look at the areas that are going to be potentially impacted the most by the cuts. And you can see that the lighter yellow is sort of the less number of workers that are going to be impacted by the $600 loss. And then over here on the red spectrum is a lot of people. And you can see, obviously, some of our largest economies, which kind of makes sense because we're also going off population. So you'll see that a big part of the central of a country is on the low end of things. And then you will see that sort of coastal areas, new northeast as well is very, very impacted. And of course, parts of the south are incredibly impacted, with some of our key states, the highest economically sort of producing or affected states being affected the highest. And this is the number of people that will end up suffering because of the inability for the $600 to come in. And there's still no clear sign whether that will continue, not continue. I mean, the talks or the proposals, because talks haven't been happening, it was just the proposals that kind of came in, landed, and now there's like all these proposals that they have to go through and negotiate back and forth to understand what will they do and what is going to happen. So that is one of the interesting pieces. Since we're on the topic of unemployment, last week we talked a little bit about Delta. There's new news about Delta and what's going on. And Delta is basically giving pilots an ultimatum. You can either take a pay cut or be furloughed. And this is an interesting piece. I'm going to read a little bit more about what exactly they're saying. But an interesting piece is that maybe a week ago, 2 weeks ago, sorry, time is running together, but in one of the previous episodes for sure, I talked about the fact that we're going to see this more prevalent thing happening within businesses, that they're going to start approaching employees and saying, you either take a pay cut or I got to let you go, because on the back end, if I let you go, there's like 10 people or 100 people or 1,000 people or 10,000 people lined up for that one job. And especially now with the $600 payment ending potentially, we don't know. I mean, it's set to end unless they extend it. It is going to end. The desire for people to actually go back to work is going to become a real thing, a very real thing, and it's going to be an interesting time this week into next week to see kind of what happens. So let's talk about what's going on. So to cut costs, Delta Airlines is giving the pilots an ultimatum: take a pay cut or risk furlough. Airline is proposing that the pilots union agree to 15% cuts to pilots' minimum wage in order to avoid furloughs for a year. Of course, they're still in talks and negotiations. Nothing has been agreed on or talked about. Delta Senior Vice President of Flight Operations said in a memo to pilots that voluntary buyouts and paid leaves weren't enough. Because last time when we talked about that they were going to go into that regard and context of doing that stuff. But again, we are seeing that not much has happened there. And I am getting reports that I might be frozen solid. And I'm not quite sure how to unfreeze myself. So maybe I'm unfrozen now. No. Yes. Let me know what's going on. Nope. I am frozen. So let me stop and then we'll come back shortly. Hold on for just a second, please. Apologies for being frozen. I'm not quite sure what happened. But the good news is we are unfrozen, ready to rock and roll. And rock and roll we will. So last time we actually ended up talking about that Delta was going to first take a voluntary buyouts and paid leaves and that kind of stuff. And now we're getting reports that that may not be enough. Delta has already sent a notice of possibly involuntary furloughs known as Worker Adjustment and Retaining Notification Act, WARN Act, notices to more than 2,500 pilots. Now, an interesting piece to pay attention to is that United Airlines has already warned 36,000 staff of possible furloughs, and American Airlines told staff they could have as many as 8,000 more flight attendants, more than they needed by the end of the year. So there you go. That's kind of what's going on. And we have also seen news, and I didn't pull it up over here, but I read the news that 73% down in travel this July from a year before. So if you didn't believe that the travel is down, there you go, 73% down. Now, what are we seeing that is very interesting? And I don't, again, have the news articles here to show you, but I did spend time learning and studying because I'm such a geek, y'all, that even when I go on vacation, I spend it learning and studying and kind of understanding what's going on. So there's a couple of things that are very key that have developed. Some of the stuff that we talked about already is that bikes. Hold on, let me turn on the fan. It's really, really hot. There we go. Oh, so much better when something, cool blows on you. So, what we have seen is that bikes were going up for, spiking up in sales. We received the news about that stuff, and that was kind of cool. But now we're seeing also interesting reports that are happening is that boats, I mean, anything that floats on water is like sold out. Uh, Campers, RVs, you can't get you. They can't produce enough of them. They are selling like hotcakes. So boats, kayaks, SUPs, stand-up paddle boards, surfboards, fans, that kind of stuff. Tents, RVs, camper trailers, all of that stuff is sold out. And of course, campgrounds are good luck getting a space. You got to go high and far, hiking, going into the wilderness to do stuff. And that's where I injured myself this weekend because we went out camping. And long story short, I fell off the hammock, landed on some roots and rocks. So I suggest be very careful with hammocks. But anyways, I mean, you couldn't find a place whatsoever. We had to go out and, hike in and do all kinds of crazy stuff to find it. But, eventually we did. And, that's one of the things that is really kind of happening, that it's kind of interesting piece to pay attention of where things are developing and what's going on. Now, talking about people, we were talking about employment and people and kind of what's going on. And I told you that people watching the show are going to understand why it is so important that you continue to watch the show and to be able to learn, because we do talk about some very, very important aspects. And we have received news that you might have heard about it, but I just recently learned about it, that the amateur traders, the retail traders buying stuff left, right, and sideways, not understanding, are now petitioning bankruptcy judges to not wipe them out. So J.C. Penney amateur traders beg judge to save them from a wipeout. What? We've never had that happen. But then again, people were not jumping in. And partially why they're jumping in, well, part of me thinks, free trading accounts, you don't have to pay anything. People are out of work, so they're bored out of their minds trying to figure out something else to do. It's much more fun and easier to just click buttons now, whereas it was in the past. And some stupid social media believe that if everybody piles into crap, the crap all of a sudden is going to turn from crap into, something wonderful. And that's not how it works. Amateur investors who loaded up on JCPenney stock shares as the retailer went bankrupt are now pleading with the judge to spare them from a complete wipeout. Mom and pop investors who insist on betting on struggling companies would be well advised to stay away from those in or near bankruptcy. And I agree. I have been saying that. You got to be very careful with that stuff, because when a company goes and files for bankruptcy, that share is useless pre-restructuring, because that is going to get wiped out. They're going to completely restructure, then issue new shares, and then it might, I didn't say will, I said might make sense to buy it. But people don't listen. They jump in because they only look at the price and they're like, ooh, look at this. It was $100 before. Now it's 10 cents. I should buy. And then they get wiped out. So it doesn't make sense, y'all. It doesn't make sense. But let's read and learn. People who buy equity hoping that they are not going to get wiped out in a bankruptcy just don't understand the process. JCPenney filed for Chapter 11 in mid-May. Basically means restructuring debts, bankruptcy. After climbing as high as 67.9 cents last month, the company stock is trading at around 30 cents now. Some of the retailers' most junior debt is quoted at less than 2 cents on the dollar, which basically implies that extremely thin odds that bondholders would get repaid, and in turn, nothing, absolutely nothing will be left over for stockholders. So, what does it work? How does it work? Let's recap this. We talked about it once when we talked about Hertz. Let's talk about it again so that you don't understand. When the company goes through bankruptcy, the first level that gets paid out with anything that may exist, including sometimes selling of the value or like sort of repositioning, is that the senior level debt gets paid first, then junior level debt. Then, when all of the debt is paid off, right, all of the different levels, and you could have multiple tiers to that stuff, right? From the first all the way to like, down to the 30th or whatever. So depending on how deep they are and how it was structured to begin with, then you go with preferred stock, then you go with common stock. Typically, when it comes to going into bankruptcy and trying to basically wipe out the debt, typically if all of the bondholders get paid, it's a good day. That means equity doesn't get anything. Common will get absolutely nothing. That stock end up being worthless. And then typically what ends up happening is the day to restructure, issue a new stock, and that's the one that kind of takes over, or they get bought out and then somebody else kind of issues it on their piece. Or if they're already public, they don't issue anything. They just kind of end up being the holder of the newly restructured company. Now, the interesting piece to kind of talk about is where is the stock right now? And here is JCPenney stock. And I actually zoomed out to max so that you can see where it was in 1980s. We were at $6. Then we climbed up to like, whopping $75 or so in 1998. Dropped down in early 2000, 2000, sorry, to $9. Went up as like, $80, $100, whatever it was. Yeah, 80 something bucks. And then you can see how it's been a steady decline. And now we are down, y'all, to a whopping 28 cents. And you can see kind of 6 months where it was, where people are going in and trying to sort of, go in and buy over 11 cents. They bought it. It went up to 63, and it's been sort of sliding down. So not a good thing, not something you want to go and buy or hold at this moment. Uh, Now, the individuals, one of the individuals that wrote an open letter to the judge basically saying, please don't wipe me out, is saying he had zero knowledge of the bankruptcy process before buying about 10,000 of J.C. Penney shares. Uh, Y'all, this is one of those reasons where I keep saying you want to be here. You want to watch this show. You want to be educated. You want to join One Deal Away Academy so that you can learn all of these things so that uh, it's really interesting. I just had a conversation with my best friend. That's whom I went out camping with and hanging out with. And we were just talking about all kinds of different things from, money, politics, health, life in general, sweet memories and just, a lot of laughter. So, but anyways, we were just hanging out and talking about it. And I said, it really blows my mind that people will go in, put their life savings into something they don't understand, get wiped out, be completely willing to get wiped out because they don't have a risk and they don't acknowledge risk, nor do they price it in, but they refuse to spend, I don't know, 20 bucks, 50 bucks, 100 bucks to learn something really, really important that has a benefit to protect their entire wealth and not just protect it, but actually structure in such a way where it can actually grow and explode in growth. And it kills me that people don't do that, but people don't do that. So now one of the things that people want, they were like, oh, but I didn't know. Well, yeah, you didn't know. So now I don't know when this individual has bought into the stock, but let's say that he even bought at 80 cents, right? That he even bought at 80 cents or even at 60 cents, and now you're down at 28 cents. You lost significant amount of money. And don't even get me started if the gentleman bought, way back when up here when it was like, 80 bucks or whatnot, and you didn't pay attention and you weren't watching for things, and then, you got wiped out. Retail investors hoping for a sale may have thought a buyer would pay cash for outstanding shares, right? Because there were some reports that somebody might buy it. And they were like, yeah, somebody's going to buy it and it's going to save us. It doesn't work that way, y'all. It doesn't work that way. Um, Yet that's practically unheard of. Somebody paying cash for outstanding shares is unheard of in a bankruptcy where any asset value that remains after close court costs belongs to the lender with senior collateral claims. Once they're made whole, meaning paid in full, other creditors, including unsecured lenders and vendors, are next in line. And then if something left over, but typically it's not. J.C. Penney's entered bankruptcy with more than $2 billion in secured and $8 billion in total debt, y'all. You need to understand that. Some recent JCPenney's investors said in an interview that they thought shares in the expectation that the company would be able to rebound once the stores reopen. And again, while they could, that's not exactly how it works. They might be able to reopen, but it's not going to get them into $8 billion, out of $8 billion hole in months. It doesn't work that way. So again, people are betting and buying on the hopes, prayers, and dreams. And I am not picking on individuals who are doing this stuff, nor am I picking on JC Penney's, nor am I picking on any other company. What I am doing is trying to get you to understand how this all works for one reason. Because people are piling in equities and things are not healthy enough for you to be in there. Yeah, you want to trade daily, sure, good luck with it. Vast majority of traders lose money trading, day trading. And now holding in for long term doesn't make sense. I mean, think about it. Look at this. If you had bought in, J.C. Penney's back in 2000, for example, at $10, right? And you rode that thing, you were like, yes, it's going up. And then you're holding on for a long term, because they tell us that that's how you're supposed to invest in stock market. You just got wiped out completely, because it's not necessarily holding on for the long term. It really is about understanding ups and downs. And, could you have predicted that this would have been bottom at $10 over here and then this was a top? Probably not. But, some of the news and listening to this channel, watching this channel, paying attention to the stuff would give you a much bigger advantage over everybody else to sort of say, wait a minute, I'm just going to pull out and sell this and collect some of the cash and then look for a new way to jump in an area where it makes sense. Stocks, I mean, I don't know that I'm crazy about them for this very reason, that you take a lot of risk, not a whole lot of reward. I mean, it's good reward. It beats mutual funds. Lord knows it beats mutual funds. But it's not the greatest asset to own. And it's just a marketing, a spectator's game to sort of play on your emotions of like, ooh, you could have won big. People that win big in stocks are people that actually own companies and list it. It's the sellers, not the buyers. Although you can, vast majority don't. So something to understand. And if you want to go and day trade, you got to get yourself an instructor, a mentor to guide you and teach you to do that stuff. Another investor said, I saw no bankruptcy coming, only the promise of turnaround and great news. Well, what are they going to tell you? They're in the business of selling. They're not going to like tug you on the shoulder and say, don't buy this, it's crap, you're going to lose everything. Because if they were to do that, it contradicts their interest. Keep in mind, when you buy stocks, that money goes to the company. That money that helps that company go in and operate and do stuff. So it's important for you to understand that they're not going to go out there, tap you on the shoulder and say, hey, Nev, hey, Joe, hey, Mary, don't buy this, it's crap. Because it's contrary to what they need to do. For me, here at Money Matters, I'm not selling stocks. I get no benefit if you buy, sell. I get no benefit if you make money, lose money. I want you to make money. I don't want anybody to lose money. But I don't gain one way or the other, which means I am neutral and I can tell the way that I see it. One place where I am not neutral and I'm being completely transparent with you is when it comes to education, when it comes to one deal away. I do believe that we have excellent products and excellent education. But again, that's not for me to say, that's for you to say and for my students to say whether they like it or not. So, anyways, I do think whether you go with one deal away or you go with somebody else, education is the key. You gotta go and learn some of these things before you just blindly put money in it. Because it breaks my heart. People do stuff. I've done stuff when it was like the worst possible time, which is buying at the top of the market, buying into bankrupt company, selling at the bottom, switching into something that doesn't make sense, and all because we don't know and we don't understand. So you want to know and understand, and only way to do that is not just by listening to somebody on YouTube like me or anybody or somebody on TV. It's by understanding the underlying principles, how it works, and thinking for yourself. That is what you want to do. And that comes with experience, exposure, knowledge, and of course, going out and trying things and then testing and tweaking to see what's happening. All right, I am off of my rant right now, and I want to go in and jump into an article that I promised that I was going to talk about. One of that is bonds are waving red on U.S. economy while stocks show green. And typically, when we see this happen, bonds typically tell the truth, which is another reason why I'm saying I don't know that I'm as crazy on the equity. However, I do want to point out something. I do have another article that says the Fed is going to buy stocks. Now, if they're not doing this, but if this is to happen, there might be change in my analysis. I will explain. Let's make sure you stay tuned in. So, bonds are basically waving red. Equity indexes are holding well above their pandemic-induced 2020 lows, yet the Treasury market increasingly is foreshadowing doubt over the pace of economic rebound. 10-year yields, considered a more pure read on growth since they strip out inflation, have dropped for the past 6 weeks and hover at about negative 0.85%. This is real, this is not nominal. What is the difference? Nominal is what you see. So right now, when you go in and you take a treasury yield, it might show like 0.65%. Real takes inflation in, strips all of that stuff, and it gives you sort of what the piece would be. So in a place where we do have an inflation, right? If let's kind of use it this way. If you put money into a savings account, right, and that savings account gives you 10%, 10%, good luck with that, a tenth of a percent, not 10%, a tenth of a percent return on your investment, but inflation is 1%. Uh, Nominal rate is 1%. Sorry, I'm going to pause. Let's do this again. Sorry about that. Okay, so you put money in a savings account and you get a tenth of a percent. Fair? So you have a tenth of a percent return. That's nominal rate. But because there is an inflation of 1%, right? At the end of that year, even though you earned a tenth of a percent, but there is a 1% sort of tax on your money, your real rate is negative 0.9. A negative 0.9% is what you have actually earned in that savings account because inflation actually eats into the value of that dollar or yen or euro, whatever. So that's where this part comes in. So they're talking about the real yield is negative 0.85, which means there is some inflation happening based off of Bloomberg's analysis and what they're sharing. The Treasury market is charting its path based on the resurgence of coronavirus and expectation that the Federal Reserve will push even harder on the monetary gas pedal, allowing inflation to run above its 2% target in the process. What the bond market is telling you that the growth will be subpar for quite some time. There won't be fresh insights on Fed policy because officials are in the blackout period for public speeches ahead of their July 28-29 meeting, and nominal treasury yields uh, that have held fairly steady over the past 10-year maturing swing between 0.57 and 0.76 over the past month. So remember, this is nominal, right? But real, they're saying real is negative 0.85. What that tells me is that there is some inflation happening, and it sounds like they're saying they're going to run inflation or allow inflation to run above 2% at some point in the future. Uh, the they're saying that basically the decline in the real yields is and the bids for safe haven assets such as gold, which actually does really well in an inflation as an inflation hedge, have surged, and those two things tell us that another troubling signal is ahead of uncertainties. And of course, we won't be able to know where the Fed is going and what they're doing because they're going to have a meeting a week from tomorrow, it sounds like, so Tuesday and Wednesday of next week, so they can't comment on that. So this week, next week are going to be very, very interesting because Congress will sort of talk about is there next stimulus or not, and the Fed is going to talk about what's happening with the interest rates and the what they are doing. Now, another article. So this is telling us that maybe the equities are not going to go up, and maybe we do have another sort of downturn, as a much more severe downturn, as a high potential in the relatively speaking near future. But we do have another article that says, well, Fed is going to buy stocks. Now, if this ends up happening, stocks have a potential to go up. It's a very good, interesting article. I recommend that you read it. It's on Forbes if you want to read it. But basically saying that the Fed is trapped. So what would happen if they rule out buying stocks? Which it doesn't make sense because I agree with him. If they're buying bonds, corporate bonds, junk bonds, bonds, why would they stop at equities? They wouldn't. So I do think that there is a high probability that they will do that. It's just a matter of time. They haven't announced it, but I think it might come maybe when we see sort of some of the tapering off. But we'll see. The Fed is already buying both investment grade and junk corporate bonds. Drawing a line in the sand with equities would only encourage a further shift toward debt financing, which they might. Unfortunately, more corporate leverage would boost equity market volatility, increasing the probability of large fall in equity prices and deep recession. And again, they might. Sometimes they don't always think that far ahead. They react in the moment. Given Fed action to date, ruling out future equity purchases would accelerate a structural dynamic that risks more frequent and deeper recession, the exact outcomes of the Fed in the mandate to avoid. The ongoing shift to retirement asset to saver controlled DC plans makes such a line in the sand when holder to hold politically. You helped out bail banks in 2008. You bought junk bonds in 2020, but now you want step to support the 401ks of individual savers. So he's arguing that that is going to absolutely happen. When long-term capital management failed in 98, the Fed feared its bankruptcy could threaten the financial system, yet they went out of their way to make the appearance of such help very sort of convoluted. And we had all these verbiage and talks and stuff that was like really weird about like how we called it. Now, 22 years later, they are basically using a loophole with special purpose vehicles to buy just about everything. And they're not shy about it. They talk about it now. Interesting. And what he's saying is Fed will buy stocks. Get ready for that stuff. Again, I don't know where I stand. I don't know how I feel about that. You let me know in the chat and in the comments of how you feel about it. If you have liked the show, smash that like button right now because I think you got potentially, hopefully, I don't know, let me know. If you liked it, do hit the like button. Some good and important, relevant information. Thank you for watching. Until next time, stay forever money blessed, and do remember, you are only one